Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Boy, losing my voice. Yeah, that's what happens when you work a lot. Anyway, as a man said, it's a Bullington Capital Report here every Saturday morning from 11 to noon, 1420. Also 6 o'clock Sunday nights. Occasionally I'll come in and do a live show on Sunday night. I don't know if I'll be here tomorrow night, but a lot of things happening. By the way, for the first time in a couple of years, the number of stocks, investable stocks that are investable by mutual funds, in a short-term uptrend have outnumbered the stocks that are in a short-term downtrend. That is very significant. It's incredibly significant. Now, you're not really seeing this much in the S&P 500 because those are overweighted by the huge, mega, large companies. And most of the stocks that are moving really fast right now are medium and smaller size. And it's a beautiful thing. And it's long overdue. 2/3 of the strategies that I run have a momentum factor in them. And momentum has been underperforming largely over the past couple of years, which is what you would expect to happen. And it happened. It's not the first time. It's very cyclical. And people, it's very difficult not to doubt something when it when it just doesn't seem to be working, especially when the cycles are more than a year in duration. That will get the vast majority of people to quit. The ones that have done well, the easiest ones to sell right now, by the way, are the dividend-based models, which are underperforming the momentum-based models in the past month. So that change, is it going to stay that way? I don't know. All the conditions that would favor that scenario are in place. They're all in place. So the momentum stuff, which has been kind of the drag on anybody's portfolios that have had any of it, probably going to surpass the dividend stuff over the next 12 to 18 months, if I had to make a guess. And there are lots of reasons for that. The fact that Trump is in the White House, I've been following that extremely closely. And it looks like he's really tagged some extremely talented people who are also billionaires and got theirs, by managing funds, being part of private equity. They were part of the growth, very business friendly. That's going to be really good for business. It'll be exceptional for business. In fact, I'm pretty sure that's one of the reasons that the trend has picked up in stocks overall, especially the small and mid cap. And those things are just flying right now. And those cycles, by the way, they tend to last 2 to 3 years. That's the general rule. Now, that hasn't, having said that, none of them are ever identical in length. But I think the odds favor a very positive outcome. Everything I've been reading that's been coming down, I have a subscription to Bloomberg. Extremely expensive. They've got more they have more journalists than the AP Newswire does. It works for them. They have a government function on their service that covers everything the government does. And everybody there is, it's going to be overwhelming. It's overwhelmingly positive based on the people that he's talking to, and looks like he's headed to a point. And that, that's a good thing. What's the downside? Well, if you increase spending a lot and you cut taxes, you will create an economy that grows pretty fast. At some point in time, 4 years, 5 years, could be longer, down the road, you could create a bubble and then you get another correction, like the one we had in the year 2000. the one like we had in 2007 through 2009. But the 4 or 5 years leading up to that could be phenomenal. So that's the don't wait until the S&P is at 3750 to invest. It's at 2000 now. That would put it up a lot. It could easily, doing the right things, could easily get to 4,000 in the next 5 to 6 years. That could happen. I remember sitting here in 2008 saying interest rates are probably going lower and staying down this level till at least 2013. Well, it's 2016 now, and they're still lower than they were when I made that statement. So, and nobody wanted to hear that either. Nobody wants to hear that. This is what it's like to be a contrarian and investment advisor. Nobody believes you until it's too late. But Barron's today, they floated a very interesting idea, and I would do this, and I hope that the administration is reading it. And I know the hedge fund managers and the private equity guys that Trump is talking to are looking at that, and I know they're having the same ideas. And if they pull this off, this would be phenomenal. If they start issuing 100-year bonds for 100 years, you're probably going to have to pay 4%. That big sucking sound you hear would be all the money leaving the stock market and the bond markets to buy those those guaranteed bonds at a 4% interest rate. Now, this is where this gets really cool. And I don't mean just from the United States. Those bonds would be in demand from every country around the world. And this would be what would be really cool about that. You raise interest rates by 1 or 2, or let a short-term CD rate get to 5%. Watch what happens to the price on those 100-year bonds paying 4%. Now, if you're a portfolio manager, you already know what I'm talking about. If you're not, that crash will make the stock market look like chump change. And see, here's the cool thing. If I sell the bonds, if I'm the United States government and I sell the bonds at $1,000 a bond, and I'm only paying 4%, and then I raise interest rates to 4% on a short-term bond, the bond price on that 100-year bond is probably coming down to $500. It's going to lose at least half of its value temporarily. Now, they are guaranteed. If you live 100 years, it is guaranteed. So one of your beneficiaries will actually be able to hang on to that bond, and they will get the $1,000 back. Okay? You will get the 4%. In the meantime, the United States government could come back in and buy that debt back at 50 or even 60 cents on, or 40 cents on the dollar. They would make trillions. So I hope they do that, because I know the public. I hear them. They come up to me all the time. I had a guy, actually more than one person. If I could just get 3.5 or 4%, and I would be good. That's all I'd need. Like, well, I guess, if you have over $1 million, 3.5% on $1 million is $35,000. By the way, you have to pay tax on the $35,000, so you're probably going to be left with about $28,000. If that were to stay that way for the next 10 years, 10 years from now, prices will be higher than they are today. They will be. That's a natural part of the economy. It's called inflation. So that money is going to not be purchasing nearly as much. And that's why you really need to shoot for returns somewhere in the 5 to 6% range. And you won't be able to, that's like a minimum. In our stock portfolios, we try to shoot for a lot more than that. Why? Because we don't put 100% of anybody's money in stocks. And that's I can't wait till we get this. We got this light board that we built. Actually, the head trader, this guy used to be a client. My head trader, his name's Gary Miller, and he does all the trading for us. And he was a client, and I showed him how to do some breakout trading, very aggressive trading. And then I watched how he did it, almost 2 years. And he did a phenomenal job. I mean, phenomenal. And by the way, he worked in a mill that made, I forgot what it was, specialty moldings for wood. Huge volume, by the way. And prior to that, he was a professional cabinet maker, worked on the Brown Stadium. And so this guy, this just goes to show, you do not have to be born into finance, or your dad doesn't have to be a CPA. You don't have to be an accountant to be good at this. It's actually more temperament than anything else. If you got the right temperament, you can do it. If you don't have the right temperament, I don't care what kind of degrees you have, you're not going to succeed. Okay. So anyway, I watched him, and he did really well, and I had the opportunity to bring him on board, and that was probably one of the better moves I made. In fact, all three of the people that work with me in our little enterprise, I'm really lucky to have them. But anyway, I called on him to build this thing called a light board. And it's a big pane of glass in a frame that's up on a stand, very heavy. And it's backlit with LED, or edge lit with LED. Put that into the molding. And so when I write on it with a fluorescent marker, it glows. And it's a really cool presentation. But the coolest thing is, when I'm writing on it, you can actually see what I'm writing. We're going to record that from the other side, so it actually looks backwards, but with the videotape, you can flip it, and you'll be reading it exactly as I'm looking at it. So that is really cool. It will help illustrate a lot of these concepts that we're talking about, that I'm constantly talking about. And because, everybody makes investing way harder than it is. They look at things, and they try to know the unknowable. They try to know, and I'd really like to address all those little things on these videos, because you're going to be able to hear my voice. You're going to be able to see my face. You're going to be able to see the writing. And more importantly, you'll be able to go back and play that video back if there's something that you missed. Or when you forget, you'll be able to go back and pull it back up and watch it again. And I'm really excited about it. I think it's going to help. We're going to resurrect the Look Out for the Bull website because of this, because it makes it a lot easier. What really makes it easier is Melissa Arcuri, the marketing director. She's going to be doing all the heavy lifting. I'm just going to produce the content, basically talk about the things I already know about. So I don't have to do a lot of research on that, just bring them out. And I'm really excited about this. It's it's just a great time to be an investor. It's a great time to be alive. Now, having said this, and here's something that I'd really like to address. I have a ton of clients who are upset because they feel like they should make more money. And we have this thing called a decline tolerance. If you're only willing to be down 15%, I can only put you 30% in stocks. 70% goes in fixed income. It's the law. Okay. In fact, mine is simpler than the questionnaires that you get from other people, and it's more blunt. How much are you willing to be down by in order to achieve the returns you want to achieve? And when you tell me 15%, basically I can double that number, and that's how much I'm limited. So you will never keep up with the stock market. You're not going to do it. To keep up with the stock market, you've got to be willing to be down 50% or more, because the stock market goes down 50% every once in a while. And when it goes down, you're going with it. I don't care what they say. The equity indexed annuities, they're BS. They don't work. In fact, during the commercial break, I'm going to pull something up, come back to talk about that in particular. Why does an equity indexed annuity not work? Yeah, now other annuities are pretty good. There are some annuities out there that are extremely cost effective. I mean, have super cheap expense ratios. Super cheap. They're very good because you get tax deferral on that. If you're going to apply for financial aid, it's my understanding that they don't count the assets in annuities. So if somebody knows something different, let me know, because I just looked that up and I think I trust the source. But that would be an asset that would help your child qualify for more financial aid. Okay. That's my understanding. So again, if you know something different, I just looked that up. But besides that, the fact that you have tax deferral and you can manage your investments, managing the investments in the long run is going to make a difference. It should make a difference. As long as you have a plan, and the plan is halfway reasonable, halfway well thought out, and you stick to the plan. If your plan's not reasonable, then sticking to it might not be such a good idea. But and you feel free to call us at Bullington Capital. You tell us what you're doing. It takes me literally a couple minutes. There are only a handful of things you can actually do with the money. Despite what other people tell you, yes, they have created thousands of products out there, but they're all variations on a theme using 5 particular asset classes, and that's it. Once you know what those, you can put those in any combination you want. I think Chinese music only has 5 notes to it, by the way. Think about how many songs they have. So, yeah, it's something crazy like that. But anyway, the bottom line is you got to have something to guide your actions. Hopefully it makes sense. Hopefully you understand it well enough to be able to stick it out during the tough times. Because that's what counts. Can you stick it out? Do you know if something major changes? And by the way, there have been changes in the market, not major changes that would cause something that worked extremely well a long time ago just to quit working. They might not be as effective as they used to be. And there are lots, those are little subtle changes, but I'm telling you, if it's based on common sense, I'll give an example. Let's say instead of investing in a market cap weighted index the way the S&P 500 or the Russell 1000 is, what if we just invested in those companies on an equally weighted basis? In the long run, that's made more money. Why? Why has that made more money? Because when Microsoft is the company number 1,000 on its way up to the top 10, you're going to put an equal amount in there when it's growing the fastest. When it gets into the top 10, which is when the market cap weighted index starts to buy more shares, they missed the ride. They caught part of the ride because they put a smaller amount in Microsoft when it was small. They waited until after it got big to increase their exposure. And that's the one thing that I just don't really like about a market cap weighted index. And if you're a billionaire and you don't really care about how much you're going to earn over the next 10 years, then fine. Buy the market cap weighted index. It's the cheapest, the least expensive way to go. Notice I didn't say it's the best. But if you're a billionaire, who cares? You don't care if you're, what's 3% of a billion? It's 30 million. You're gonna spend $30 million? Yeah, I know a lot of people that would in a year, but the vast majority of people won't. Anyway, I hear the music. That means I have to take a real quick commercial break. You listen to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. Hey, I've got a correction to make. I had read in more than one place, by the way, on the internet, that Jimmy Carter had a PhD in nuclear physics. I'd read that in multiple places, and I'm shocked. I've heard it bantered around. Anyway, I got somebody that found a source on the internet that says he actually, although he did some graduate work, his highest degree attained was a Bachelor of Science. So I'm correcting myself. That's one of the problems with the internet. You can find just about anything on there, and it's very difficult to verify exactly what you're hearing. So, and I encourage everybody, everything I ever say, go and look it up. If I'm wrong, I'll admit it big time, as quickly as I can. So anyway, thanks for that. I appreciate it. And hang on one second. And I'm just actually emailing this guy back right now. So incidentally, if you want to email me during the radio show, you can. It's bill@bullingtoncapital.com, bill@bullingtoncapital.com. And one of the things that I'm very sure about are the equity indexed annuities. Here, I just looked this up. So basically, what they do is they say that they're going to guarantee your principal, and you have the chance to make stock market-like returns. Okay, that's what people get from the material. Now, a lot of the material doesn't say that. It's implied. And some of them, some of the old really egregious ones say that. And a lot of people that sell the products will say that. But realistically, you can't really do that. What they do is they're either using futures or an ETF, and they're basically they'll buy futures on the S&P 500 or buy an ETF like SPY represents that. They buy insurance on that. It's called a put. It's a hedge. And I'm looking at the cost of a December 21st. That's a month from now. December 21st put on the SPY. It's $4. So you're going to pay $4 to guarantee that you could sell that at $220. Okay. Right now, SPY, let me pull it up here, is $218.50. So why did I say $220? Because you can't get one exactly at $218.50. You go down to $215. That would give you the. They probably won't do that, by the way. And if you did it, $215. Now it's got to drop 3 points. Plus, you're paying $2, so you'd actually lose $5. In this case, the loss is going to be a little bit smaller because you're going to get $220 minus the $4, okay, that you paid for the insurance. So actually, your break even is like $216, which is slightly below where the market is right now. So they could say, all right, well, we're actually going to buy that, hope that it doesn't crash, and if it goes up, we'll make a little bit of money on it. If it goes down, we've got some downside protection, and that is true. That's absolutely true. The tough part is you're charging 2% a month. $4 is 2% of 200. You're talking about $220. So you're paying close to 2% per month for the insurance. And what they're actually doing is they're doing this every month. They know some months the market's going to go up a lot more than 2% in a month. So they'll actually be profitable in those months. In the other months, they're going to sell that, or when it goes down, they're actually going to put that, and they may make a profit in it, but they might not. It's got to go down far enough for that put to kick in so that they can actually make more money on the put and offset the loss on the underlying instrument, which is going to be incredibly difficult to do, by the way. So I know that's really complicated, and that's why one of these products, they need to be regulated more closely, under more scrutiny. Right now, they're getting away with not being considered a securities product, although they're investing in securities. They're actually being ruled by insurance departments throughout all 50 states. Realistically, and this isn't going to change, by the way. The legislation now, or the current administration, probably not going to pay a whole lot of attention to this. So you have to know this stuff on your own. Those things will drop in value. Well, actually, what will happen is there's this thing called a market value adjustment. And I get emails from this stuff all the time too, guys. They're constantly. And by the way, now, a lot of them most of them pay between 8 and 10% commissions. Think about that for a second. Holy cow. Yeah, that is unbelievable. Now, they tell you that you don't pay anything, but take your money out early and watch what happens. Take your money out beyond the penalty period. There's a penalty period. They call it a contingent deferred sales charge. Take your money out beyond that and watch what happens when they employ the market value adjustment. So bottom line is these things are not good. You got to look at them. You've got to look at them. And annuities are all over the map. Some of them are very good. Some of them are awesome. Some of them not so much. So you really have to know what you're doing. And I will tell you that a lot of people that are selling the products, it's a lot easier to get an insurance license than it is to understand complex derivatives. It's 10 times easier. So we've been talking here on the show for the past few weeks about a Jefferson National. It's now they're owned by Nationwide. Nationwide bought these guys out. It's a flat fee. It's $20 a month. That's what they charge for their administration fees, which is the lowest in the industry. Fidelity's got a really low cost one, and I have a feeling, in fact, I've seen another one come out from one of the other firms that has much lower expenses on it too. So it's a trend that's probably going to catch on, and it's a beautiful thing. You have 300 and some odd funds. Most of them have multiple funds. Fidelity's got a good one. I think I saw Jefferson National too. Jackson National was coming out with an RIA version of this. So basically what you're doing is you're getting the tax deferral, and you're not paying those insurance costs. By the way, that cost that I was just talking about, that's just a hedging cost. That's not the mortality and expense charges. Those are on top of that. Some of these contracts have so much in fees that it's literally impossible to make any money with. And those typically pay the highest commissions, by the way. So if you've got an annuity and you want somebody to take a look at it, we've got a database. We can look it up. We can tell you what your costs are, whether or not you've got one of the good ones. So feel free. Give us a call. Email us. It's bill@bullingtoncapital.com. Go to my website, Bullington Capital. Just fill out the contact form. Say, hey, you've got a form. You can scan it and send it to us, or we can you can mail it to us. But give us a call, and we'll be glad to take a look at that. I don't mind people using good products or people understanding what they're buying. Back when these things first started, you had a menu, and you could choose those guarantees that you wanted, and they showed you what you were paying for them. A lot of that stuff has, it depends on the company, really. It does. And it also depends on, person that's selling it. And they are incredibly complex. I mean, I took the options principles exam, which hardly anybody does because it is really difficult. It's like learning a foreign language. But it's for hedging, taking options, futures contracts. And when I got all the way through that, and then I got through my training and I started trading, and I was going, wow, this is a really long run for an extremely short slide. You'd be better off just doing regular stock investing. It's incredibly complicated and very difficult to make money in, by the way. So even if you do, and occasionally, you can hit a homer, and I'll talk about them, looking at leaps on things. When the stock market goes sideways for 2 years, it makes everybody want to quit, doing those sort of things because it won't make any money, or it won't make much money. And just difficult. But again, going back to something that we'd talked about earlier in today's program, you look at where the S&P 500 is, SPY. It traded at a price in 2014 that was just 3% below where it is today. It's 2016. Okay, that's 2 years, and that's the S&P. By the way, it's done better than a lot of the other indexes, especially the ones that have smaller companies in them. Smaller companies these got crushed. It's unbelievable. In fact, last year I think I know it was the Russell 2000 from peak to trough. It was down 25%, and you're not hearing about that. All you hear about from the news media is every time the Dow makes a new high. Who cares? Yeah. By the way, the Russell is at an all-time high right now, the small cap. After being down 25% in 2015, up through the first part of 2016, was down 25%. And now it's recovered all of that. And it's actually slightly ahead of where it was in 2014, not by a lot, a little bit, but things are looking good. And this is one of the things that is really hard for a novice investor who's sitting at home. This is pretty normal. To go 2 years like that, that's not that long. For a market to be choppy sideways, that's really not that long of a time period. There are lots of time periods like that. Look at the 1987 through 1992. I remember that too. It was tough. People had always heard, well, the stock market averages 10% a year, but I haven't made any money. Well, see, that's a long-term average, not a 4 or 5 year average. That's a long-term average. 10 years or better. In fact, there are lots of 10-year time periods where the return's been negative. Think about that for a second. So when they say long-term, they mean really, really, really long-term. And that's what, unfortunately, the public has not been informed on, because it's not very, people don't want to talk about that. People don't want to talk about 1978 to 1982 when interest rates went from the low teens to the high teens. Or they don't want to talk about 1966 through 1982 where the Dow was stuck in a range from 1,000 to 600 for 13 years. They don't want to talk about that. The people that sell investments don't want to talk about that. And that's actually what makes me different. I think you need to know because you're going to find out whether I tell you or not. Because that's how it works. You go through some fairly long time periods where the market doesn't do a lot. I think we're on a time period where the market has the opportunity. It looks better now than it has in a long time. Not just because Trump's in, the GDP had already started growing. Probably for the first time in 8 years, we're going to be above a 3% GDP growth. He hasn't even taken office. He hasn't done anything. So first time in 8 years, we're going to get there. And by the way, increasing spending, the way he's talking about doing, and cutting taxes will give you a short-term boost. It will. And you need to take advantage of this. You really need to take advantage of this. If you're not in a stock-oriented strategy, and if you don't have 60 to 70% of your assets in stocks, you're going to miss it. 50 would be a minimum. Unless you're above the age of 85, yeah, maybe not 50. But in fact, it's a case-by-case basis. But don't expect to make a lot of money if you're not in the stock market. And I just can't imagine. You look at bond prices, and they've just been crushed. Look at that TLT, the long-term treasury. There's an ETF that actually invests in those treasuries. And these are treasuries. It's down 15% since July. Think about that for a second. We'll come back to that in a second. But I got to take a quick phone call. And I got Brian. Brian, how you doing?
Hey, Bill. How are you doing?
Pretty good.
Great. Hey, I wanted to answer your question. It was about from the seminar.
Sure.
When we were talking about the small banks and S&Ls.
Right.
That list you gave us. I was trying to, some of those, I was having trouble like pulling up the symbols. And I think, I don't know if it's because their OTC is the market they're on. Are they like too small maybe?
No, they all have at least $100 million in revenue. So if you weren't able to find, I'll resend you the list and I'll put the symbols on there for you. And that actually surprised me because I thought the symbols were on there. I probably,
No,
what?
they were, but I literally, like Folio wouldn't take some of them.
Oh, I'd have to call Folio. No, because all those banks are.
Banking,
Pardon me.
well, like that one is called Coastal Banking. Their market cap's only like $37 million.
Yeah, that's the market cap. That's not the revenue.
Small.
It could be.
But
yeah.
I didn't know if, I don't know, maybe Folio has some kind of minimum.
They might. Yeah, they might have that.
Okay.
I probably should have asked them before I did that. But
well, I mean, if that's the case, I mean, I have 14 out of the 20. I mean, I could still do a little mini ETF with 14 of them. That's still pretty good diversification.
Yeah, it is. Especially those stocks because they were selling below 2 times book value, had $100 million, and they had a return on equity of 10%. So those are very small. They're very small companies, and have the most potential. Actually, and you could. Hey, I hear the music. That means I got to take a break. Can you hang on? We'll be back.
Sure.
Okay, all right. We'll be back after these messages. You listen to Bill Bullington right here on 1420.
When you were young and your heart was an open book, you used to say.
And we're back. Hey, Brian, you still there?
Yeah.
Okay. Hey, the other thing I was thinking, I just looked these up. You could also buy the Spider. It's an ETF. It's KRE. It's full of regional banks. They do have a lot of larger ones in there, but a lot of the larger ones are actually relatively low price too. And I got to believe that they'll probably be merging so there will be some more mergers that'll accelerate a little bit. And there's another one. It's the iShares Dow Jones U.S. Regional Banks, IAT. And if you look at their charts, they're nearly identical because they've got mostly the same stocks in them. Now the other thing you could do is when you're running the scans, do you run the scans on Telchart?
No, I didn't run
Okay.
the scan.
Okay. I was just going to say, if you're doing that, when you see them come up on the scans, because there are a ton of them, and you see them whose price to sales ratio is less than 3, and then you look up their price to book ratio and it's less than 2, that's another good way of locating those types of companies. There are a ton of them out there. Now the one price to sales ratios on those things get up above 4 or 5. I'm just not interested in that. It's there's not enough potential gain there to warrant the kind of risk that they're going to have of just owning any stock, really. But yeah, so those ETFs are probably a pretty decent way of doing that too. Those things are a lot easier. You don't even have to think about it. It's just buy it, and you've got a whole basket full of stocks right in the fund.
Yeah. Okay. Awesome. All right. Well, thanks a lot, Bill. I appreciate it.
All right. Thanks for calling. Have a good day. And if you'd like to call 216-901-0945, 216-901-0945. And again, you know what's interesting, and you never know if a move in the market is going to follow through, how long it's going to last. All that kind of stuff is impossible to know, and it doesn't stop people from asking. By the way, and I know it's really funny. A lot of my seminars, I used to do this, but people were getting too mad at me. I would say, listen. Okay, I'm gonna tell you what the stock market's gonna do over the next 6 months. And everybody gets really quiet every time I've done that. And I would say stocks are gonna go up and stocks are gonna go down. Eventually, it was amazing how many people would constantly get quiet when I would say that. You really don't know for sure what the market's gonna do over the next 1 or 2 years. Over the next 10 to 20 years, I'm watching Warren Buffett, and he's talking about that. The guy's 86 years old, and he's saying, hey, 10 years from now. So that's a true long-term investor. And I think he's right. I think he's absolutely right. Stocks are not overpriced at this point. I think they're going to be fine going out. You give it a long enough time period, I think they'll be phenomenal. Well, I shouldn't say phenomenal, because everybody has a different definition of that. Phenomenal for me is if I can beat inflation by 3 or 4%, that's phenomenal. That's what I'm looking for. And that's a minimum. Which, if inflation gets back up to 6%, that means you've got to be averaging 10%. And if that environment does play out, I think we can. I think it's possible. People forget back in the 1980s, when the market went on that big tear, huge 5-year run. Inflation was double digits and was coming down. They were dropping interest rates, but they were dropping them from money market rates that were 18%. You wanted to get a home loan or a mortgage, you were paying 20%. Think about that for a second. And that's what the market started its big run on. At the highest interest rates in the history of the country is when the market started that big move. So think about that for a second. And while you're thinking about that, I've got Alan from Home Savings. Come on. Hey, Alan, how you doing?
Hi, Bill. How are you? It's been so long since I called, I forgot the phone number, so I had to wait for you to announce it.
Oh, that's funny. Yeah. I forget it while I'm sitting here, so don't feel bad.
Yeah. Well, yeah, but I didn't have the benefit of playing on the line at Vanderbilt University, so I have no excuse.
Yep. But so Alan, I asked Alan to call in today because he's with Home Savings, local bank, as a mortgage officer there, and had some interesting insights, especially for home builders. I would think that I look at real estate prices all the time just because my dad was a home remodeler for 45 years, and I worked with him for a long time, so just had an interest in it, real estate in general. Never. I can tell you, I have not done nearly as well on my real estate investing as I have on my other investments, which is why I haven't added anything to them in forever. But when I'm looking around, I would be so much more tempted to build a home than I would be, or have a home built for me, than I would be to go out and buy someone else's. And I just feel a little bit safer.
Yeah, I agree with that. Well, I would, only because I've been around it for so many years. And, again, the builders that I work with, they build everything from $200,000 homes, which, believe it or not, you can still build something in that price range, up to over $1 million. And, what you're getting is obviously the best, newest floor plans that are available. And they keep really improving on this stuff. And the only way, if you look at a house that was built in the 80s and then go look at some new construction, you really see how far. And you ask yourself, gee, what were they thinking? Well, it's just things evolve and people's tastes evolve, and they really keep getting better and better. The quality of the construction, although it's different than it was, obviously 50, 70 years ago when they were using plaster walls, it's, for the most part, it's really better. And
absolutely. And you should.
They've really made a lot of changes that are until you go in there and you see what they're doing now with energy efficiency and floor plans and everything else. It's just it's mind-boggling.
It really is.
From standpoint of just the cost of money right now, obviously it's really, really low. So,
right.
And that's one of the things I wanted to throw out for you to maybe talk about next week or in the weeks
Sure.
to come. One of the biggest questions that I run into, and I'm doing a lot of empty nesters, people that are actually building houses and getting ready to retire in the next few years. So they have income right now, but they know their income is going to change. And the question that they ask me, and I generally defer them to their financial analysts for the answer is, how comfortable should I be with this payment once I retire? And, that's kind of a loaded question, which I know you address all the time on the show, is how much income will I need to retire? How much income will I have when I retire?
And what was the metric? You gave me a metric once on assets. What percentage of assets could be counted towards payments on a home loan?
Well, yeah, I mean, if you're the way we, they've been using these metrics forever, and we push the envelope a lot. But basically, you were always considered gold if you spent 28% of your gross monthly income on a house payment or less than that, and we push through that envelope every day. But that's 28% of your gross income.
Okay,
so,
but when you've got, let's say a guy has low gross income, but he's got $500,000 in assets or $1 million in assets.
Well, yeah. See, that's where our metrics aren't very good because we're basically using 2% of those assets.
Okay, which that's perfect. Remember, we talk about the 5% withdrawal rate. That's what I feel comfortable with. And if you're taking 2% of the 5%, that's 40% of what you're taking out of your investments to live on to go towards housing. So that I see that. I get that. That's a very good number. And I know people would like, well, I got $1 million. I only want to buy $1 million home. Well, guess what? You spend $1 million. How are you going to eat? Or you spend a big portion of that, and you can't make the house payment on the rest of it. Yeah. So I get it. So you basically, with me, you're preaching to the choir. For the two of us together, talking to people that might be listening to this, I think it probably opened some eyes. But that's good. I mean, we're giving them a metric now. So if you've got $500,000, they'll allow you to credit $10,000 roughly to your annual payment. So divide that out. It comes a little over $800 a month. That would be towards a house payment. And they shouldn't go more than that because you're still going to need to eat. So,
so on top of that, they've got their Social Security income, they've got their investment income, and I've got some clients who are lucky enough to still have STRS and things like that, or pensions, and so they've got several streams of income, and they're doing quite well. But the metric is a little different once you're retired. There's always going to be plenty of retired people who can afford to do whatever they want, and that's great. But for some people, it's really helpful if you're thinking about building or you're thinking about making an investment. Try to do it while you're still working. It makes things a lot easier to qualify or to leverage yourself than afterwards.
Right.
And and remember, you can always recast a mortgage too. So if you're getting some lump sum income or lump sum payment at some point and you're not totally comfortable with the payment that you put yourself into, you could put a significant amount down, and then we just re-amortize the loan, and then your payment is going to be smaller for the life of it. But
you
I
have
would also
options.
caution people, try to stay in those 30-year mortgages if you can. Don't put yourself into a box with a 15-year loan or something just because you want to have it paid off quick.
Right, and that's the other thing. Until I met you, I'm not sure if that was just my impression or if I thought, hey, you know what? The show is actually
hear music.
Yeah, we got to go. Hey, this is Alan Bricado, Home Savings. Spit out your phone number real quick.
440-530-3626.
Well, hey, thanks for calling, and you can also reach me on my website, and I can email you his information if you'd like to talk to him. Been listening to Bill Bullington right here on 1420 every Saturday morning from 11 noon.
Another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.